Usually when we talk about a medical diagnosis, there's this kind of underlying expectation of just absolute precision.
Right, yeah. Like it's binary.
Exactly. It's also like engineering. You break your arm, you go to the hospital, they do an x-ray, and it shows that jagged white line right on the screen.
And the doctor just points to it.
Yeah, they just say, there it is. It's broken or it's not. It's clean, and honestly, it's comforting. We really like things to be visible and categorized, neatly put into boxes.
I mean, that human desire for clarity makes total sense. We want the mechanics of the world around us to just be, transparent and easily diagnosable.
But then you step into the world of institutional capital, you walk into these back rooms where the future of the global economy is actually being funded, and suddenly that x-ray machine is just completely broken.
Oh, totally.
We're looking at a financial landscape that is incredibly murky. I mean, the vast majority of this activity happens completely behind closed doors, far away from, the public stock exchanges. And yet, this invisible machinery dictates the apps you use on your phone. It determines which retail stores actually survive in your neighborhood, and it even funds the core infrastructure of your city.
Yeah, and the opacity there, it isn't a bug in the system. It's actually the defining feature.
Right.
We're talking about this complex ecosystem that deliberately thrives on specialized knowledge, private networks, and a really severe lack of public disclosure. The mechanics operating beneath the surface are just entirely different from what everyday retail investors see when they log into their brokerage accounts.
Which is exactly why we're doing this. Today's mission for this deep dive is to demystify that elite, opaque world. We're looking at the behemoth that is private equity. And our guide today isn't, some high-level Wikipedia summary.
No, definitely not.
We are digging straight into the dense, behind-closed-doors curriculum used to train elite financial analysts. Specifically, we're looking at the Schrazer Notes 2025 Level 3 CFA curriculum on private markets.
That's the real deal.
Yeah, it is. We're going to provide you with a shortcut to being deeply well-informed on how institutional capital operates when the public just isn't watching. We're mapping out the entire life cycle of private equity. From the high-stakes, cash-burning venture capital bets, through the scaling phase, all the way to massive, debt-fueled, leveraged buyouts.
And we're getting into the math, too.
Oh, yeah. Most importantly, we're going to break down exactly how these investors value companies and engineer these brilliant, almost foolproof downside protections for when things inevitably go wrong.
Because understanding private equity, it's not just an exercise in abstract finance. It's fundamentally about understanding the physics of the modern business world.
Right.
It's studying how the businesses you interact with every single day are birthed, how they're aggressively scaled to global prominence, and, occasionally, how they are ruthlessly dismantled, reassembled, and just sold for parts.
Okay, let's unpack this. We have this highly technical financial curriculum right in front of us, and I promise you we are going to decode the underlying mechanics without drowning you in all the jargon. But before we can even talk about the really aggressive strategies these private equity titans use, we kind of have to look at the canvas they're painting on.
Yeah, the basic foundation.
Right. We have to understand the fundamental life cycle of a company itself.
So the CFA curriculum structures this life cycle into 4 distinct stages, which are startup, growth, mature, and decline. And to really grasp what happens at each of those stages, you have to visualize 2 very specific financial trajectories moving over time.
Okay, I'm visualizing.
You have the revenue trajectory and you have the cash flow trajectory. And the relationship between those 2 lines, well, that dictates absolutely everything about who will invest in that company and on what terms.
Let's paint that picture for the listener. If you picture a timeline moving forward, that revenue line during the startup phase is basically, it's scraping the floor.
Just flat.
Completely flat, hugging zero. The company is, locked in a room developing a product. They're desperately trying to find market fit. And there's virtually zero money actually coming in the door.
Right.
But then, as they push into the growth stage, that revenue line starts to curve upward, and it curves aggressively. The product works, adoption is spreading, and revenue starts compounding. It's that classic hockey stick growth that every founder dreams of.
Exactly. And following that trajectory, we eventually hit the mature stage. So the market becomes saturated, competitors have likely entered the space, and that super steep revenue curve begins to plateau.
It levels out.
Yeah, the company is now this reliable, established entity just churning out its product. And then finally, there's the decline stage, where the revenue line actually starts to slope downward, usually because the core product becomes obsolete or, the company is simply outmaneuvered by newer technology.
So that revenue story, I mean, it makes intuitive sense. You start with nothing, you sell a lot, you stabilize, you fade. But the cash flow, that's where the actual drama is. That is the lifeblood of this entire private equity ecosystem.
Oh, absolutely. The cash flow reality is starkly different from the revenue story. During that initial startup phase, while revenue is hovering around zero, cash flow is not zero. It is deeply, violently negative.
Because they're spending everything.
Right. The founders are just spending massive amounts of capital on research, software development, hiring specialized talent, initial marketing campaigns. It is a period of intense, sustained cash burn.
They literally call it the valley of death for a reason. You are just shoveling money into a furnace, hoping a viable product pops out before you run out of fuel.
And honestly, many don't make it out. But for those that do, as the company enters that growth phase and the revenue starts accelerating, the cash flow curve slowly starts to climb out of the abyss. Roughly midway through the growth phase, it crosses the zero line.
So they finally break even.
Yeah, the company becomes cash flow positive. And by the time it enters the mature stage, cash flow is not just positive, it's generating a massive surplus. A
Yeah.
mature company isn't plowing every single dollar back into rapid expansion anymore, so a huge portion of that high revenue falls straight to the bottom line as free cash flow.
Okay, so we have these two trajectories. And the curriculum maps the three primary private equity strategies perfectly onto these distinct stages.
It lines up perfectly.
It really does. You have venture capital stepping into the void during the startup phase. You have growth equity taking the baton during the growth phase. And finally, you have buyout equity taking over during the mature phase.
Right.
I like to think of a company's journey kind of like a rocket launch. Venture capital is that highly volatile, highly combustible fuel required just to escape Earth gravity.
Yeah.
You are burning insane amounts of cash in seconds, the G-forces are crushing, and there's a very high probability that the whole thing just explodes right on the launch pad.
That's a great way to look at it.
But if it works, you reach orbit. And that's where growth equity comes in. Growth equity is the orbital thruster. You've made it to space, the core concept of the rocket is totally proven, and now you just need a sustained, calculated burn to propel you to your final destination.
The moon.
Right. The moon. And buyout equity. Buyout equity is like taking an aging satellite that's been in orbit for a decade, sending a specialized crew up there to dock with it, swap out all its degraded parts, upgrade the solar panels, and just make it highly profitable to operate again.
What's fascinating here is the causality underlying that analogy.
Yeah.
That's what drives the entire capital market.
Right.
Why do we actually need entirely different categories of investors at each of those stages? I mean, why can't a bank just fund the rocket launch?
Right, because if I want to open a traditional business like a restaurant, I just go get a small business loan. Why can't a tech startup do that?
Well, a traditional commercial bank looks at a startup and sees zero collateral, zero historical revenue, and deeply negative cash flow. There's just no mechanism for the startup to service monthly interest payments.
They can't pay the mortgage.
Exactly. The bank simply cannot participate. So the startup requires an investor who is willing to accept the total loss of their principal in exchange for a massive, unconstrained upside. They need pure equity.
Right.
But then, fast forward to the mature phase, that company now has highly predictable, massive cash flow surpluses. It doesn't need high-risk venture fuel anymore. In fact, using venture capital at that stage would be wildly expensive and inefficient.
Because giving up equity when you're already rich is a bad idea.
Precisely. A mature company can easily afford to take on significant debt because it has the cash flow to make the interest payments. So the fundamental financial instrument shifts from pure equity risk at the beginning to structured debt-heavy capital at the end. The company's biological needs change, so its predators and symbiotes change as well.
That makes total sense. Which brings us to the most dangerous part of the curve. Let's zoom all the way in on the very beginning, the startup phase, the riskiest part of the journey where the cash burn is at its absolute worst. Let's talk about venture capital and what the curriculum reveals as the incredibly brutal math of startups.
Oh, is brutal. The texts break the venture capital life cycle down into 3 chronological phases. First is the drawdown phase. This is the deployment of seed capital to essentially establish the business entity, fund the initial day-to-day operations, and begin the actual development of the product itself.
But the curriculum notes a really crucial distinction here. Before a VC fund even writes that seed capital check, there's usually a precursor. They call it pre-seed financing.
Yeah, pre-seed capital is the true ground zero. This money almost always comes from the founders themselves, their families, and their friends.
The classic friends and family round.
Exactly. It's the capital used to build a really crude prototype, or just simply prove that the concept isn't completely impossible. Institutional VCs, they rarely want to be the very first dollar in. They need to see that the founder has actual skin in the game. If you can't convince your uncle to give you 50 grand for your idea, a VC is highly unlikely to give you 5 million.
That's a fair point. So you tap out your network, you build the prototype, and you secure the seed capital from a VC during that drawdown phase. Then what?
Then you enter phase 2, which is the investment phase. This is where follow-on financing occurs, what we commonly hear referred to as Series A, Series B, Series C rounds.
Right. You always see those headlines.
Yep. But the critical mechanism here is that this capital is never, ever guaranteed.
Yeah.
It is strictly contingent on the portfolio company hitting very specific pre-agreed operational milestones.
So they don't just hand you a blank check and say, cool, see you in 5 years.
Not at all. The VC will say, look, we will give you your Series A funding, but only if you hit 100,000 active daily users by Q3, or only if you secure regulatory approval for your prototype.
It's totally metric-driven.
Very much so. If the startup hits the milestone, the next tranche of funding is unlocked. If they miss the milestone, the VC faces a really hard decision. I mean, they might inject emergency capital, but very often they will simply turn the spigot off and walk away, leaving the company to die.
Wow. And if the company somehow survives all those series rounds, we reach phase 3.
Right, the returns harvesting phase, the ultimate goal. The VC fund exits the successful investment usually through an IPO or maybe an M&A transaction where a larger corporation just buys the startup and the VC distributes those massive returns back to their own investors.
Okay, so that's the high-level roadmap. But we need to look under the hood at the actual math of this because the curriculum lays out a reality check that is genuinely startling. We are talking about the 100 under 1 rule of thumb in venture capital. The curriculum poses a scenario that illustrates the stark, unforgiving nature of this whole asset class. Let's walk through this carefully.
Yeah, the premise of the scenario is pretty modest. A venture capital fund manager sits down and says, our goal for this fund is to have just 5 successful investments.
Just 5?
Yeah. 5 companies that don't die, that go on to raise subsequent financing rounds, and eventually exit. Just 5 wins.
I mean, that sounds incredibly achievable. You're a high-powered VC, you have billions in capital. Just go out and find 5 good companies.
You'd think so.
Uh,
But the curriculum introduces the baseline reality of early-stage investing. The standard failure rate is roughly 80%.
80%? That's huge.
It means out of every 5 investments a VC makes, 4 will be total write-offs. They will literally go to 0. Only 1 will succeed.
So wait, if they only succeed 1 out of every 5 times, and their mandate is to secure 5 total wins, 5 times 5, they have to make 25 separate investments just to mathematically guarantee those 5 successes.
Yes. They have to consciously build a portfolio of 25 companies, fully underwriting and deploying capital into each one, knowing with absolute certainty that 20 of them are totally doomed.
That is wild.
But that's just the capital deployment side. To understand the sheer scale of the operation, we have to apply the 100-101 rule, which governs their deal flow and due diligence.
How does that rule work?
The rule of thumb states that for every 100 business pitches a VC fund reviews, they will only select 10 to undergo thorough, deep dive due diligence. And of those 10 that survive that initial vetting, they will ultimately only invest in 1.
1 single investment for every 100 pitches they sit through.
Exactly. So let's complete the equation. If the fund managers know they must make 25 final investments to secure their 5 wins, and they only invest in 1 out of every 100 pitches they take, they must review 100 times 25.
Oh my God.
That is 2,500 pitches.
2,500 pitches. I really want to linger on this for a second. They have to sit through 2,500 pitch decks, founder meetings, and product demos just to find 5 companies that simply survive to the next funding round. Not 5 generational unicorns like Uber or Airbnb, just 5 survivors.
Just 5 that don't go to 0.
I have to push back on this because it sounds fundamentally broken. Is this just a sheer volume game? Are VCs basically just throwing spaghetti at the wall to see what sticks? Or, does this indicate a fundamental flaw in the founders themselves? Like, are 2,475 of those pitches just completely incompetent?
It's a very natural reaction to look at a 99% rejection rate and an 80% failure rate and assume the system is just completely flawed.
Yeah.
But it's not random spaghetti throwing, and it's certainly not that the founders are incompetent.
Really?
Yeah, I mean, many of those rejected pitches are from brilliant engineers with stellar resumes. The math reflects something much deeper. It's the profound inherent risk of establishing product market fit from a dead standing start.
Product market fit. That's the holy grail, right?
Yes, absolutely. You can have a visionary founder, perfectly written code, a flawless pitch deck, and a product that functions exactly as designed. But until you actually release that product into the wild, you simply do not know if a critical mass of human beings will actually change their daily behavior to use it and, more importantly, pay for it.
Right. You can't predict human behavior.
The 80% failure rate isn't a failure of execution. It's a failure of prediction. Predicting consumer behavior, market dynamics, and competitive responses for a product that has literally never existed before is incredibly difficult.
It's practically impossible.
Most ideas, even the brilliantly executed ones, just don't have a large enough addressable market that actually cares. And the VC is paid to take on the risk of that unknown. They had to sift through 2,500 ideas to find the 25 teams capable of executing, knowing full well that the unforgiving free market will brutally reject 20 of them anyway.
So it's a highly curated volume game designed to absorb the chaos of the free market. You basically have to endure the 20 failures to find the one company that returns 100x and pays for all the losers.
That's the venture model in a nutshell.
Okay, so what happens to that rare mythical startup that actually survives the 80% failure rate, the ones that make it out of the startup phase, the ones where the market actually cares, and that revenue curve starts bending violently upwards? Well, they enter the domain of growth equity. And the curriculum positions this as the bridge to maturity.
Yeah, and the landscape changes completely here. The startup phase is officially over. The product is established. The market has loudly validated the concept. The company has survived the valley of death.
They made it out.
They made it. So growth equity steps in with a singular mandate. The rapid, profitable expansion of this proven product into a massive, total addressable market. They want to scale, and they want to scale globally.
And the curriculum points out that mechanically, GE investors are pretty similar to VCs in that they take minority stakes. They aren't buying the whole company and taking over the board. They're just buying a 10% or 20% slice to inject the capital needed for this massive expansion.
Right.
But there's a fascinating professor's note in the text that I found really illuminating. It explicitly states that there is no clear, objective consensus on when a VC-backed company officially transitions into a GE-backed company. The lines are totally blurred. It notes that a seasoned VC firm that is funding the rollout of a recently launched product could easily be viewed as engaging in a young growth equity strategy.
The transition is definitely a spectrum. It's not a hard border you cross on a specific date.
So let me challenge the distinction then. If VC is all about proving the concept, achieving that elusive product market fit, is growth equity purely just a massive marketing and distribution play? Are they just throwing gasoline on a fire that someone else already started? If the lines are blurred, when does the fundamental nature of the investment actually change?
What you're identifying there is the shift in the core risk profile. It's less about a formal label change on a term sheet and much more about how the investor actually underwrites the risk.
Okay, go on.
In venture capital, the primary risk is existential and binary. Will this product work at all? Will anyone buy it? But in growth equity, that existential question has been answered with a resounding yes. The primary risk shifts entirely to execution and operations.
Like supply chain stuff.
Exactly.
Yeah.
How fast can we manufacture this? How efficiently can we build out a global sales team? Can we capture market share before legacy competitors reverse engineer our product?
So the risk goes from invention to logistics.
Precisely. Much of GE capital goes into building infrastructure warehouses, localized marketing campaigns in new countries, huge enterprise sales forces. The label officially changes in the mind of the investor when they look at the company and say, I am no longer taking a gamble on whether this product should exist. I am taking a calculated operational risk on this management team's ability to execute a flawless global rollout.
It's kind of the difference between funding the eccentric inventor in a garage who is trying to invent the telephone versus funding the massive industrial operation required to lay telephone cables across an entire continent.
That captures the dynamic perfectly. The invention is VC, the cable laying is GE.
All right, so the cables are laid. The hypergrowth phase eventually cools down, the company reaches maturity, it has a massive, stable revenue stream, and that beautiful, deeply positive cash flow surplus we mapped out earlier.
The cash cow phase.
Yeah. But over time, maybe the company gets a little sluggish, it gets a little bloated, the edge is gone. And that is when a completely different kind of predator enters the ecosystem. Let's talk about the heavyweight division of private markets, buyout equity and leveraged buyouts, or LBOs.
This represents a massive philosophical and mechanical shift in how capital is deployed. Buyout equity focuses entirely on mature companies. But they don't just target any successful mature company. They specifically hunt for companies that are fundamentally failing to maximize their potential value.
Which raises an obvious question, right? Why would a mature, successful company with massive cash flows fail to maximize its value? Why would it just leave money on the table?
The curriculum attributes this inefficiency largely to a concept known as agency costs.
Let's break down agency costs, because this is the psychological driver of the whole buyout industry.
So the agency conflict arises when the management of a company, the agents who are hired to run it, begin to act in their own self-interest rather than in the strict financial best interest of the actual owners, the shareholders, who act as the principals.
Right.
Imagine a mature, publicly traded company. The shareholder base is highly fragmented. Millions of people own tiny fractions of the stock through their index funds. Because the owners are so dispersed, the CEO and the executive management team gain an immense amount of unchecked power.
And human nature takes over.
Inevitably. Management might start prioritizing their own job security, demanding excessive compensation packages, utilizing corporate jets, or just pursuing prestige vanity projects that look good on a magazine cover, but ultimately destroy return on capital.
I get comfortable.
They get very comfortable. They avoid necessary but painful cost-cutting measures, like laying off redundant middle management or closing underperforming factories, simply because it's unpleasant and causes internal friction.
They start playing golf on Friday afternoons instead of ruthlessly optimizing the global supply chain. They lose the hunger they had back in the startup phase.
Exactly. And the agency cost is the quantifiable lost value between what the company is currently generating and what it could be generating if it were run with absolute ruthless efficiency.
And that spread, that lost value, is the blood in the water that attracts the buyout firm. But unlike VC and GE, buyout firms do not mess around with minority stakes. The text is definitive on this. BO firms take controlling stakes.
They want the whole thing.
They buy the entire company, or at least a supermajority, so they can unilaterally dictate terms. They don't want a seat at the board table, they want to own the table. If they want to fire the CEO on day one, they can.
Absolute control is the prerequisite for their strategy. They need that unmitigated authority to implement the aggressive operational turnarounds required to unlock that trapped value. They can't ask for permission to cut costs. And the curriculum details 3 specific types of targets that buyout firms look for to execute this strategy.
Let's walk through those 3 targets.
The first is the take-private transaction. This involves a private equity firm buying all the outstanding shares of a publicly traded company and delisting it from the stock exchange, pulling it back into the private markets.
Keeping it private.
Right. The major advantage here for the BO firm is the high level of information disclosure. Because the target was a public company, the PE firm has access to years of heavily audited financials, SEC filings, and quarterly earnings transcripts before they even make a bid.
They can model out exactly where the fat is before they buy it. What's the second type?
The second is the carve-out. This is a fascinating maneuver where a PE firm buys a specific division or subsidiary from a much larger corporate parent.
Give me an example of that.
Let's say a massive global conglomerate has a highly profitable logistics division, but the parent company has decided to pivot strictly into software. That logistics division no longer fits their core mission, so they sell it off to a private equity firm as a standalone entity.
I was thinking about the mechanics of the carve-out. It sounds incredibly delicate. It's almost like extracting a vital organ, say a liver, from one body, and then having to artificially build a completely new life support system, a new nervous system, and a new blood supply around it immediately so it can survive on its own.
That is a very visceral but highly accurate way to look at it. When a division operates inside a massive conglomerate, it is deeply entangled. It relies on the parent company's centralized HR department, its sprawling IT infrastructure, its unified payroll software, and its global legal team.
Right, it doesn't have its own HR.
Exactly. When the BO firm carves that division out, it is suddenly severed from all that support. The PE firm has to build all of that operational infrastructure from scratch at breakneck speed while ensuring the core business doesn't miss a beat. The operational complexity of a carve-out is just staggering.
And the third target type.
Private company sales. This is acquiring an existing, mature private company that has perhaps hit a natural ceiling. Maybe it's a family-owned manufacturing business where the founder is ready to retire and there's no clear succession plan. Or perhaps the company just has insufficient funding to modernize its factories. The BO firm sees immediate opportunities for cost-cutting and efficiency improvements.
Okay, so we understand the targets and we understand the motivation, but let's get into the actual plumbing of how these transactions happen. Because we are talking about buying companies worth billions of dollars.
Right.
The PE firm doesn't just, log into their checking account and wire $3 billion. The curriculum spends a significant amount of time detailing the M&A mechanics, the mergers and acquisitions mechanics of a typical leveraged buyout, and it is a masterclass in financial engineering. Walk us through this two-step process.
The mechanics are brilliant. Let's say the PE buyout fund, which the curriculum refers to as the financial sponsor, wants to acquire a target company, which we will call TGT-Co.
The financial sponsor wants to buy Target Co.
Got it. Step 1. The financial sponsor does not buy TGT-Co directly. Instead, they create a brand new, empty legal shell company. We'll call this Shell Onco for Acquisition Co.
Okay, a shell company.
Yes. The sponsor takes their investors' equity capital and injects it into Onco. Then Onco goes to a syndicate of banks and takes out massive short-term bridge loans. Onco then uses this newly created mountain of capital, the equity plus the short-term debt, to purchase all the equity of TGT-Co.
Wait, so the empty shell company is the entity actually executing the purchase?
Yes, but here's the critical mechanical trigger. The moment the ownership of TGT-Co changes hands, the moment Onco takes control, it almost universally triggers what is known as a change of control clause in TGT-Co's existing debt agreements.
Why does that happen? Why do the lenders care who owns the equity?
Because the original lenders underwrote the debt based on the old management team and the old corporate structure. When a private equity firm swoops in, the risk profile changes instantly.
They don't trust the new guys.
Right, the original lenders want out. So the covenants require TGT-Co to immediately repay all of its historical debt upon the change in ownership. This means TGT-Co itself must suddenly take out its own massive short-term loans just to pay off its old creditors.
Let me make sure I'm tracking this because it sounds crazy. So at the end of step 1, Onco owns TGT-Co, but Onco is loaded up with short-term debt from buying the company, and TGT-Co is loaded up with short-term debt from having to refinance its historical obligations. It sounds incredibly precarious.
It is, but it is entirely transitional, which leads directly to step 2. Once the acquisition is legally closed, Onco and TGT-Co are formally merged into a single post-LBO corporate entity.
They smashed them together.
Exactly. This newly merged behemoth then immediately goes out to the broader capital markets. They issue new long-term capital, typically a mix of high-yield bonds and syndicated leveraged loans, and they use the proceeds from that long-term debt issuance to completely pay off all the short-term bridge loans from step 1.
So it's essentially a massive coordinated refinancing operation that takes place in the immediate aftermath of a takeover. They use temporary scaffolding to buy the building and then quickly replace the scaffolding with permanent steel girders.
A perfect analogy. And once that long-term debt is locked in, the clock starts. The BO investor executes their turnaround plan. They fire the underperforming managers, they strip out the bloat, they merge redundant departments, and they use the newly optimized massive cash flows of this mature company to slowly pay down that mountain of debt over the coming years.
And as the debt goes down,
The equity value held by the PE firm goes up.
So what does this all mean? I want to clarify something here because the curriculum makes a very specific point to distinguish an LBO from another debt-heavy maneuver called a dividend recapitalization. In both scenarios, a company takes on a massive amount of debt, but the underlying intent is entirely different, right?
It is a vital distinction. A dividend recapitalization occurs when a company's owners decide to issue new debt for one specific singular purpose: to use the borrowed cash to pay a special, massive dividend directly to themselves, the existing shareholders.
Wait, they literally borrow hundreds of millions of dollars just to hand it to themselves as a cash bonus?
Yes. The corporate finance justification is often that it optimizes the firm's balance sheet by decreasing its weighted average cost of capital, or WACC, since debt is generally cheaper than equity financing. But functionally, it's a mechanism for the owners to extract liquidity from the business without having to actually sell their shares.
Sounds like taking out a second mortgage on your house just to go to Vegas.
In some cases, Critics would definitely agree with you. An LBO, conversely, uses debt as a tool to facilitate a complete change in the ownership structure. The debt is the crowbar used to acquire the asset. And crucially, an LBO is always paired with a concrete, aggressive, operational action plan to improve the company's fundamentals so it can service and eventually retire that debt. A dividend recap usually lacks any operational turnaround plan. It's purely financial engineering on the balance sheet.
Okay, so we've analyzed the big three strategies in isolation. We've got venture capital funding the volatile startups, growth equity funding the rapid scaling phase, and buyout equity executing the massive debt-fueled turnarounds of mature companies. This brings us to a really interesting part of the curriculum, the showdown.
Right, comparing them directly.
Let's put these three strategies in the ring together. The texts provide a comprehensive side-by-side comparison of their defining characteristics. Let's look at how an institutional investor actually evaluates and chooses between them.
When you look at the fundamental metrics side by side, the contrasts are stark. Let's examine the time horizons first. Venture capital requires the most patience. The typical investment horizon is 5 to 10 years before the fund can harvest returns.
Makes sense. You're building from scratch.
Right. Growth equity and buyout equity have significantly shorter horizons, typically targeting an exit within 3 to 7 years.
Then look at the investment sizes. VC is relatively small on a per-company basis, typically deploying $1 million to $10 million in early rounds. Growth equity has a massive range depending on the scale of the global rollout. But buyout equity is strictly heavy-duty. The text notes these investments are always greater than $10 million, but in practical reality, they are routinely in the hundreds of millions or even multiple billions of dollars.
And finally, consider the form of investment, which dictates the risk profile. VC is purely equity-based. You buy common or preferred stock, and if a company goes bankrupt, your equity is wiped out. You lose everything. Growth equity introduces convertible instruments to protect the downside, which we will explore deeply. But buyout equity utilizes a complex capital stack: equity, convertible instruments, and heavy reliance on debt.
Here's where it gets really interesting. Look at those time horizons again in relation to the investment sizes. VC is putting in a relatively tiny $1 to $10 million, and they have to sit on their hands and wait for up to a decade. Buyout firms are deploying hundreds of millions, managing the insane complexity of M&A carve-outs, taking on massive leverage, and yet their time horizon is only 3 to 7 years.
It seems counterintuitive.
Right. Why does the time horizon actually shrink as the investment gets massively larger and seemingly more complex? You'd assume that turning around a bloated global conglomerate would take a decade.
If we connect this to the bigger picture, the underlying mechanism there is tied directly to the life cycle curves we discussed at the very beginning. In venture capital, the GP, the general partner managing the fund, is fundamentally waiting for a market to mature. They're waiting for consumer psychology to shift and adopt a new technology. You cannot force a market to develop on your own artificial schedule. It takes 5 to 10 years for a startup to organically embed itself into the economy.
You're waiting on the world to change, and the world moves at its own pace.
Exactly. But in a leveraged buyout, the asset is already fully mature. The market demand is already proven. The revenue and cash flows are already locked in. The PE firm is not waiting for organic market development. They're executing a highly specific, internally controlled operational turnaround.
They're pulling levers themselves.
Right. They're aggressively cutting costs, renegotiating supplier contracts, firing redundant staff.
Yeah.
These are actions that are fully within their unilateral control. Once they execute that plan and unlock the trapped value, say it takes 3 or 4 years of heavy lifting, they want to exit immediately.
But why the rush to exit once it's fixed? Why not hold on to a highly profitable, optimized company?
Because of the ticking clock of debt and the mechanics of IRR. Holding the asset longer once the primary value has been unlocked actually begins to drag down their annualized return metrics. Their primary goal is to maximize the internal rate of return for their investors, and IRR heavily penalizes time.
That makes profound sense. The VC is planting a seed in the ground and has no choice but to wait for the weather and the seasons to do their work. The buyout firm is flipping a house. They want to buy it, get the crew in there, rip out the kitchen, fix the roof, stage it, and get it back on the market as fast as humanly possible to maximize their annualized yield.
That is the exact operational mindset.
Speaking of maximizing returns and getting back on the market, how do these investors actually measure their financial success? And more importantly, how do they protect their massive downside while keeping their upside potential totally uncapped? This brings us to the valuation and structuring section of the curriculum. The mechanics of returns and convertible preferred shares. This is the heavy math section, and it is absolute genius.
Before we dive into the share structures, we need to clarify how these funds report their success to their investors. The curriculum draws a sharp distinction between ROI and IRR.
Return on investment versus internal rate of return.
Yes, ROI is a very simple multiple. It simply compares the total cash flows ultimately received back to the original cash invested. If a fund puts in $10 million and eventually harvests $30 million, the ROI is 3x.
Super simple.
But the critical flaw with ROI is that it is entirely agnostic to time. Earning a 3x return in 1 year looks mathematically identical to earning a 3x return over 15 years under an ROI calculation.
Which is useless if you care about the time value of money. Earning 3x in 1 year makes you a financial god. Earning 3x in 15 years barely beats a standard index fund.
Precisely. That is why IRR, the internal rate of return, is the absolute gold standard in private markets. IRR calculates the annualized effective compounded return rate. In an IRR calculation, the timing of every single cash flow matters immensely. Receiving a dividend payment in year 2 dramatically increases your IRR compared to receiving that same dividend in year 5.
And as we just discussed, that ticking IRR clock is the invisible whip that drives buyout firms to exit their investments so aggressively in that 3 to 7 year window. Okay, let's dive into the most fascinating structural math in this entire curriculum. The text provide a deep dive into how growth equity investors utilize convertible preferred shares, or CPS, to engineer their investments. I want to work through this math together very carefully because this represents the secret sauce of how institutional capital protects its money from failure.
It is a masterclass in risk mitigation. Let's establish the baseline parameters of the example provided in the text. Imagine a growth equity firm is investing into a company that has just proven its product. The terms are as follows. The GE firm invests $20 million in cash. Okay, $20 million in. In exchange for that capital, they are issued 100,000 convertible preferred shares. That implies a purchase price of $200 per share.
Got it. $20 million in, 100,000 preferred shares out. Simple enough.
Now we build the downside protection. These specific shares come attached with a 2x liquidation preference.
What does that mean?
This clause dictates that if the company is ever sold, liquidated, or pushed into bankruptcy, the GE investor is legally guaranteed to receive twice their initial investment, back before the common shareholders, the founders, and employees are allowed to receive a single dime.
So they jump the line.
Yes. Since the GE firm invested $20 million, their liquidation preference guarantees them the first $40 million of any exit.
Wow, think about the psychological weight of that on a founder. If the company struggles and the founders have to organize a fire sale and sell the whole business for, say, $35 million total, the GE investor uses that preference to sweep the entire $35 million off the table. The founders, who spent years of their lives building it, get absolutely zero.
That is the harsh reality of the downside protection. The GE firm protected its capital at the expense of the common equity. But what happens if the company is wildly successful? That is where the convertible mechanism activates.
Okay, let's hear the upset.
The investment terms state that the GE investor has a 3-to-1 conversion ratio. This gives them the absolute right at any time of their choosing to forfeit their preferred VIP status and convert those shares into common shares. 100,000 preferred shares multiplied by 3 gives them 300,000 common shares.
Okay, so the GE investor has a constant choice hovering over them. Keep the VIP preferred status with the $40 million ironclad guarantee, or tear up that safety net and trade it in for 300,000 regular common shares. How do they mathematically determine which path to take? I assume we need to know the total share count of the company.
Exactly. The curriculum provides the capitalization table. Prior to this GE investment, the founders, the employees, and the early VC investors collectively hold 1,838,235 common shares.
Okay, let's work through the math. The GE investor is sitting on a $40 million guaranteed safety net. For them to act rationally and voluntarily give up that $40 million guarantee to convert to common stock, the 300,000 common shares they would receive must be worth more than $40 million.
Exactly. We are calculating what is known as the optimal conversion point.
Right.
You take the $40 million liquidation preference and you divide it by the 300,000 common shares they would receive upon conversion.
So if $40 million divided by 300,000 shares, that comes out to $133.33 per share.
$133.33 is the threshold. If the company's common shares are valued at less than that, the GE investor stays in their preferred position and takes their $40 million preference. If the common shares are valued at more than $133.33, they exercise their right to convert and ride the equity upside.
Let's scale that up to understand what the total company needs to be worth. If the break-in price is $133.33 per share, what is the total implied equity value of the entire business?
We multiply that break-even price by the total number of common shares that would exist post-conversion.
Okay.
The GE firm would have 300,000. The founders and early investors have 1,838,235. Add them together, and you get a fully diluted total of 2,138,235 common shares. Multiply that total share count by the $133.33 threshold price, and you arrive at a total equity value of $285,098,000.
Let me make sure I'm fully grasping the magnitude of this structure. $285 million is the total equity value threshold. This convertible share structure acts as a financial Kevlar vest that guarantees the GE firm a massive return if things go poorly, but automatically transforms into a lottery ticket if the company moons past $285 million. It is an incredible piece of financial engineering.
It perfectly bridges debt and equity. To solidify this, the curriculum details 3 specific exit scenarios to illustrate how the investor behaves based on that threshold. Let's walk through them.
All right, put me in the shoes of the GE investor. Walk me through my outcomes.
Scenario 1, total failure or fire sale. The total equity value of the company at exit is under your $40 million preference. Let's say it sells for $30 million. What is your move?
I don't convert. I take the $30 million.
Exactly. You choose not to convert. You exercise your liquidation preference. You take the entire $30 million. The common shareholders get nothing. You mitigated your losses as mathematically efficiently as possible.
It's brutal for the founders, but my LPs are somewhat protected. What's scenario 2? Scenario 2, moderate success. The total equity value at exit is between $40 million and our magic conversion threshold of $285 million. Let's say the company is acquired by a competitor for $100 million. What is your move here?
So $100 million total.
Again, you choose not to convert to common shares. Why? Because if you converted, you would own roughly 14% of the company. 14% of $100 million is only $14 million. Why take $14 million when your preference guarantees you $40 million? So you stay preferred, you take your $40 million right off the top. The remaining $60 million is then distributed among the common shareholders. You secured a safe 2x return, and the founders still get a decent payday.
The safety net works flawlessly. And scenario 3, the moonshot.
Scenario 3, massive success. The total equity value explodes past $285 million. Let's say the company goes public in a massive IPO valued at $500 million.
Now we're talking. If you relied on your $40 million preference, you would be leaving a fortune on the table. So you execute your conversion rights, you tear up the preferred status, and transform your holding into 300,000 common shares. You now own roughly 14% of a $500 million company. Your stake is suddenly worth $70 million. You share in the uncapped upside right alongside the founders.
That structure is almost unfair in its brilliance. I mean, it essentially shifts the vast majority of the downside risk onto the founder's common stock, while keeping the unlimited upside completely open for the private equity firm.
It is the defining architecture of growth equity. It allows institutional capital to take aggressive swings at scaling businesses while maintaining a very hard floor on their losses.
Okay, so we've seen the incredible upside, we've walked through the complex M&A mechanics, and we've analyzed these clever downside protections with convertible preferred shares. But private equity is still an incredibly risky asset class compared to just buying a diversified S&P 500 index fund. What are the hidden traps? Where do these sophisticated investors actually lose their shirts? Let's navigate the minefield.
The CFA curriculum is very transparent about the dangers, listing a myriad of specific risks inherent to private markets. You've got liquidity risk, valuation risk, agency, operational, interest rate, leverage, macroeconomic, and dilution risks.
It's an absolute minefield.
It requires extreme navigational skill. But let's focus deeply on 2 specific risks that the text highlights as paramount for these strategies: dilution risk and information asymmetry.
Let's start with dilution risk. Conceptually, this is when your slice of the pie gets smaller because the company decides to bake more pie, right? They issue more shares to new investors.
There's exactly the mechanism. And the text notes that it manifests very differently depending on the specific strategy. Venture capitalists face immense constant dilution risk in subsequent funding rounds.
How so?
If you invest early in the seed round and the company survives to raise a Series A, a Series B, and a Series C, they are issuing massive blocks of new shares at every single stage. If your VC fund does not have the reserve capital to participate in those later rounds, to exercise what is called your pro rata right to maintain your ownership percentage, your stake gets drastically reduced or crammed down.
You could start out owning 20% of the company at the seed stage, and by the time they IPO, you've been diluted down to owning like 2%.
Precisely. Your brilliant early bet gets watered down by later capital. Now, buyout investors face a completely different flavor of dilution risk. They usually own a controlling supermajority stake, and they aren't out raising new venture rounds, so they aren't worried about outside capital diluting them. Their dilution risk comes entirely from the inside. It happens when those convertible securities we just analyzed change hands, or more commonly, when the management team exercises their stock options. Remember, BO firms must grant management equity to align incentives and solve the agency cost problem. When management eventually cashes those options in, they receive new shares, which dilutes the BO firm's total ownership percentage. So giving management a piece of the pie to solve the agency cost problem actually introduces dilution risk as a direct side effect. It's an unavoidable trade-off. Which brings me to a core assumption I want to challenge here. We said earlier that taking a controlling stake in a buyout effectively eliminates agency risk from the corporate management because the PE firm is now the undisputed boss. But doesn't that just shift the agency risk onto the LPs? This raises an important question. Let's follow that logic. How do you see the risk shifting?
Well, think about the limited partners, the pension funds, the university endowments, the wealthy individuals who actually supplied the billions of dollars to the private equity fund in the first place. Don't they now have to blindly trust the general partners, the PE fund managers, to not act in their own self-interest?
You've hit on one of the most fundamental tensions in private markets. The agency cost absolutely does not disappear. It merely relocates up the food chain. In a public company, the agency conflict is between the dispersed retail shareholders and the corporate CEO. In private equity, the agency conflict is squarely between the limited partners, the providers of capital, and the general partners, the deployers of capital.
Because the GPs charge massive fees. We always hear about the classic 2 and 20 model, a 2% annual management fee on committed capital and 20% of the profits. A GP might be highly incentivized to just gather as much money as humanly possible, simply to collect a massive 2% fee on a multi-billion-dollar pool, even if they know they can't find enough good companies to invest it in.
Or, conversely, they might take wildly excessive risks with the capital to try and hit that 20% performance hurdle, knowing full well that if the fund goes bankrupt, the LPs lose all the money while the GP only loses their time. This profound agency conflict is severely compounded by the other major risk highlighted in the text: high information asymmetry.
Information asymmetry, the condition where one party in a transaction possesses materially more knowledge than the other.
And in private markets, the asymmetry is staggering. In public equity markets, information is democratized by regulation. You have mandatory quarterly earnings reports, SEC filings, independent auditor opinions, and armies of Wall Street analysts covering the stock. The playing field is somewhat leveled. In private markets, there is a massive structural information gap between the GP and the LP. The GP is sitting inside the boardroom of the portfolio companies. They know every operational detail, every looming lawsuit, every missed sales target. The LP, however, only receives periodic, heavily curated, often highly opaque reports from the GP. The LP is largely sitting in the dark regarding the day-to-day reality of the massive assets they technically own.
So the GP has all the power, all the control, and all the actual information. How does an LP protect themselves from being taken advantage of?
That is why the curriculum insists that rigorous due diligence is the absolute non-negotiable bedrock of private markets. An LP cannot simply look up a Morningstar rating or read a quick analyst report. They have to intensely, forensically underwrite the GP themselves before committing capital.
They have to investigate the managers.
Exactly. They must analyze the GP's historical track record across multiple economic cycles. They must audit their internal operational processes, dissect exactly how they structure their hidden fees, and ensure the GP has significant personal wealth tied up in the fund to align their incentives. If an LP fails at the due diligence phase, they are entirely at the mercy of that information asymmetry for the next decade.
The due diligence process is literally the only flashlight they have before they lock themselves in a dark room for 10 years.
And if the batteries in that flashlight die, they are in serious trouble.
Well, we have covered an immense amount of ground today. Let's briefly retrace this journey we've taken through the mechanics of institutional capital. We started in the volatile, cash-burning days of venture capital, where we unpacked the brutal reality of the 100-101 rule, watching managers sift through 2,500 pitches just to find 5 startups capable of surviving the unforgiving free market.
We then explored the transitional phase of growth equity, where the fundamental investment risk shifts away from basic product viability and moves entirely toward operational execution and global scaling. We also broke down the brilliance of convertible preferred shares, demonstrating how they provide a mathematical safety net on the downside while preserving infinite upside potential.
And finally, we explored the heavyweight arena of the leveraged buyout, where mature companies are taken private, loaded with complex tiers of debt, and subjected to ruthless operational turnarounds to eliminate agency costs and maximize enterprise value over a tight, high-pressure 3 to 7 year horizon.
It is a remarkable, deeply interconnected ecosystem that funds and shapes the entire spectrum of corporate existence, from a sketch on a napkin to a global conglomerate.
It really is. But before we sign off, I want to leave you, the listener, with a final concept to ponder. Something that builds directly on the mechanics we've discussed today. We just spent a lot of time talking about how private equity relies on information asymmetry and the severe illiquidity of the assets to generate these massive market-beating returns. They get paid a premium specifically because they navigate the murky, opaque waters that the general public cannot access.
The illiquidity premium is a foundational tenet of the entire asset class. You demand higher returns because your money is locked up and you lack perfect information.
Right. But what happens if this industry continues on its current path of democratization? What if everyday retail investors eventually get easy, frictionless access to private market funds through the standard brokerage apps on their phones? If a flood of retail capital enters this space, transparency and heavy regulation will inevitably be forced upon the market to protect those everyday investors. Will that sudden transparency and liquidity effectively erase the very premiums that made private equity so lucrative in the first place?
It is a fascinating paradox facing the industry. By making the asset class accessible to everyone and shining a light into the dark rooms, you might fundamentally destroy the unique characteristics that made it desirable to anyone.
Will the private market just eventually devolve into a slower, more expensive, and less efficient version of the public stock market? It's something to mull over as the financial landscape shifts. We want to thank you so much for joining us on this deep dive. The next time you walk down the street, look closely at the businesses around you, the local coffee shop trying to expand, the tech startup advertised on a billboard, the massive logistics company delivering your packages, and ask yourself, where do they sit on that life cycle curve? And what kind of capital is pulling the inevitable levers behind closed doors? Until next time, keep diving deep.